Have you ever, found yourself wading through a company's financial report and feeling like there's this secret language hidden in the numbers and all those footnotes?
Oh, definitely. Yeah.
Or maybe you just want to get beyond the surface and really grasp the philosophy behind how companies everywhere tell their financial story.
It's a really common feeling. Financial reports are designed to show financial health, but, well, without knowing the blueprint, they can feel incredibly dense, almost impenetrable sometimes.
Absolutely. And that blueprint, that's exactly what we're digging into today. We're doing a deep dive into the conceptual framework for financial reporting. You should think of this as the bedrock, the document that governs how financial info is structured, presented all around the world.
Yeah, the foundation.
Our mission here is to sort of distill the most important bits, the real nuggets of knowledge, to help you understand the why behind those statements. What makes information reliable? How do companies account for everything from a huge factory down to some future obligation?
Think of it as a shortcut, maybe, to being genuinely well-informed about the real core of financial reporting.
Exactly. A shortcut to understanding the fundamentals.
And just to be clear, our source material for this deep dive is a close look at that key document itself, the conceptual framework for financial reporting. Specifically, we're focusing on chapters 1 through 7. That's where they lay out all the fundamental principles.
Okay, great. So let's jump right in. Chapter 1, the objective of financial reporting. It seems like it's about way more than just crunching numbers, right?
It really is, yeah. At its heart, these general purpose reports are designed to help users. And that includes you listening make informed economic decisions about a company, an entity.
Okay.
And these reports do that by following IFRS accounting standards. And those standards, they're directly underpinned by this conceptual framework we're talking about.
Right. So the framework isn't just some theoretical exercise stuck in academia. Does it have practical uses, say, for the IASB itself?
Oh, absolutely. Very practical goals. First, it helps the International Accounting Standards Board, the IASB, develop and revise the actual IFRS standards. It gives them a consistent, logical basis.
Okay.
Second, it helps companies create their own consistent accounting policies when maybe there isn't a specific IFRS standard that covers something, or, sometimes a standard gives you choices.
Fills the gaps.
Exactly.
Yeah.
And maybe most crucially, it helps everyone, preparers, auditors, users like you, understand and interpret the standards properly.
That makes its role much clearer. It's a guidepost. But what happens if a new IFRS standard, for whatever reason, actually goes against the framework? Does the standard just automatically win out?
That's a good question. Yes, the IFRS accounting standards do take precedence over the framework. They are the specific rules.
Okay.
However, if a new standard does depart from the framework, the IASB has to explain why, publicly.
Transparency.
Exactly. It keeps them accountable for those decisions. You need a very good reason to override the fundamental principles.
Now, here's something in Chapter 1 that feels like a really big deal. The introduction of stewardship. This seems to add a whole new layer beyond just, profit and loss. How does it change what financial reports are telling us?
It's a really significant addition, you're right.
Yeah.
The IASB specifically brought in stewardship because users need to assess two things.
Mm-hmm.
One, the potential for future cash coming in.
Right, the future prospect.
And two, management stewardship of the company's resources.
Yeah.
How well did they look after what they were given?
Okay, so it's not just about the bottom line.
Not anymore, no. It means financial reports aren't just a scorecard for financial performance. They also give you critical insights into how well management is actually looking after the company's assets, its resources. It's about accountability for those resources.
Holding them accountable.
Yeah, for what's been entrusted to them. It gives you a much fuller picture of their overall performance, not just the financial results in isolation.
That's a really vital distinction. Not just what they achieved, but how they manage the resources along the way.
Okay, this leads us perfectly into Chapter 2 then.
Yeah.
What makes information useful?
Mm-hmm.
Because, we're swimming in information today, right? Not all of it is actually helpful.
Precisely. Information overload is real. This chapter clarifies what actually makes financial information valuable. But, and this is important, always considering the cost.
The cost-benefit constraint.
Right. The benefits of providing the information have to justify the expense of, gathering it and presenting it. And at its core, there are two fundamental qualitative characteristics.
Okay, what are they?
Relevance and faithful representation.
Relevance. I think most of us get that intuitively. It has to be capable of making a difference in the decisions users make.
Right, exactly. If it doesn't influence a decision, it's not relevant.
But faithful representation, that sounds a bit more, I don't know, philosophical. Can you break that down? It does sound a bit abstract, maybe.
All right.
But it basically means the information truly depicts the economic substance of what it's claiming to represent.
So it's accurate.
It's more than just accurate in a narrow sense. It must be complete, doesn't leave important things out. It must be neutral, no bias.
Yeah.
And it must be free from error. It's about painting an honest economic picture.
Complete, neutral, free from error. Okay. And then there are these 4 enhancing characteristics that kind of boost the usefulness.
Right. They make the fundamental characteristics even better. You've got timeliness, understandability, verifiability, and comparability. All pretty self-explanatory, but essential.
Got it. Now, let's talk about prudence. This seems really important for making sure that information is neutral, for that faithful representation aspect.
It absolutely is. Prudence is basically exercising caution when you have to make judgments under uncertainty, which happens all the time in accounting. It supports neutrality by making sure assets and income aren't, overstated, and liabilities and expenses aren't understated. Users value this because it helps counteract that natural optimism, maybe even bias that management might sometimes have.
So it stops things looking perhaps artificially good.
Essentially, yes. It ensures the financial picture isn't overly rosy or aggressive. It brings a dose of caution.
Now, what's really fascinating here, I found this really interesting, is how the framework talks about substance over form. I, and probably a lot of listeners, always thought that was like a standalone core principle of accounting.
It's a common understanding, but the framework clarifies it in a subtle but important way. The IASB concluded that substance over form is not actually a separate component of faithful representation.
Really? How so?
Instead, they argue that if financial statements just represent a legal form that's different from the underlying economic reality, well, then by definition, they cannot be a faithful representation.
So it's baked in.
Exactly. It's not an extra rule you apply on top of faithful representation. It's an inherent part of it. If you are truly faithfully representing the economic phenomenon, you are, by default, reflecting its substance, not just its legal form.
That's a great clarification. Okay, now this next point, this really made me think. The idea of asymmetric prudence. I've definitely seen this with standards like IAS 37 on provisions.
Yes, provisions and contingency.
Right, where a probable outflow, like you probably have to pay someone, gets recognized as a provision, a liability, but a probable inflow, you'll probably receive money that only gets disclosed as a contingent asset. It's not put on the balance sheet.
That's the classic example.
It seems odd, right? Like 2 sides in the same lawsuit could end up with different accounting, even if the chance of winning or losing is exactly the same. How does the framework view this kind of asymmetry?
It is a vivid example of asymmetric prudence in action within a specific standard. The framework's general stance, though, is that it should not identify asymmetric prudence as a necessary characteristic of useful financial reporting overall.
So it doesn't mandate it everywhere?
No. While it acknowledges that this kind of asymmetry might sometimes pop up in specific standards like IAS 37, perhaps because requiring the most useful information in that context leads to it, the framework itself doesn't say prudence must be asymmetric as a general rule. It aims for neutrality, unless a specific standard explicitly requires that asymmetric approach for a really compelling reason.
Interesting. So the goal is neutrality, but specific standards might create exceptions.
Okay. And going back to faithful representation doesn't mean perfect accuracy, like every single number has to be precise to the penny.
No, absolutely not. Perfect accuracy is often impossible, especially with future uncertainties. Estimates are a really essential part of financial reporting.
Go.
Think about depreciation or allowances for bad debts or warranty provisions. Those are all estimates. And using them doesn't necessarily weaken usefulness. The framework is all about striking a balance between relevance and faithful representation.
How does it strike that balance with uncertainty? Well, it suggests that if a measurement is highly uncertain, maybe it's better to use a less uncertain estimate, even if it's not perfect, provided you give clear explanations about the uncertainties involved. It's about giving the most useful information possible in the circumstances, even if it involves judgment, rather than just throwing up your hands and providing nothing because it's not perfectly precise.
Got it. Transparency about the uncertainty is key. Okay, let's move on to Chapter 3, Financial Statements and the Reporting Entity. So when you, the listener, pick up one of these reports, what exactly are you looking at? What's the main goal?
Fundamentally, the financial statements are there to provide information about the entity's economic resources, its assets, the claims against those resources, liabilities and equity, and the changes in them, which are income and expenses.
Okay, the core elements.
Right. And this whole package of information is designed to be useful for assessing, well, future cash flows, and also, circling back to our earlier point, management stewardship, how well they manage things.
And where do we find this info?
You find it spread across the main statements. The statement of financial position, that's your balance sheet. The statement of profit or loss or income statement. The statement of cash flows. The statement of changes in equity. And really importantly, the disclosure notes. They provide all the extra context and detail.
Right, the notes are crucial. So it's basically like a snapshot of assets, liabilities, equity at a point in time, say December 31st.
End of the period.
And then a kind of movie showing the income and expenses over that period, like the whole year.
That's a great analogy. Snapshot and a movie.
And that's why comparative information is so important, right? To see the trend.
Spot on. You always get comparative figures from the previous period or periods, so you can identify trends, analyze changes, see if things are getting better or worse.
And underpinning all of this is a fundamental assumption.
The going concern assumption. Yes. Financial statements are normally prepared assuming the entity isn't about to go bust, that it will continue operating for the foreseeable future.
Unless they state otherwise, of course.
Unless stated otherwise, exactly. And that assumption really impacts how assets and liabilities are measured. You measure things differently if you think you'll use them versus if you think you'll have to sell them off quickly.
Makes sense. Okay, chapter 4. The elements of financial statements. These are the absolute building blocks, aren't they? Why is it so critical to have really precise definitions for these?
It's absolutely crucial for consistency and comparability. Imagine if different companies defined asset or liability differently. You wouldn't be able to compare them at all. Financial statements would be, well, meaningless for comparisons.
Chaos.
Pretty much. So the framework lays down clear definitions for the 5 core elements. Do you want me to quickly recap them?
Yeah, let's do a quick rundown.
Okay. First, assets. These are present economic resources controlled by the entity because of past events. The key is control and potential future benefit.
Got it.
Second, liabilities. These are present obligations. The entity has to transfer an economic resource, again, because of past events. It's a duty they can't realistically avoid.
Okay, an obligation.
Third, equity. That's simply the residual interest. What's left in the assets after you deduct all the liabilities. It's the owner's claim.
Assets minus liabilities.
Basically, yes. Fourth, income. This represents increases in assets or maybe decreases in liabilities that result in equity going up, but excluding any money put in by the owners themselves.
So earnings, essentially.
Broadly, yes.
Yeah.
And finally, expenses. These are the opposite. Decreases in assets or increases in liabilities that make equity go down again, excluding any distributions made to the owners, like dividends.
Right. These definitions really underpin absolutely everything in accounting.
Every single transaction gets analyzed through these definitions.
Okay, simple sounding, but fundamental. So, Chapter 5 tackles recognition and derecognition. This is the big question of when something actually gets put on the books or taken off.
Exactly. When does an asset or liability and a related income or expense officially get included in the financial statements? That's recognition.
And what are the principles for that?
An item should be recognized if recognizing it provides you with, firstly, relevant information, secondly, a faithful representation of the item, and thirdly, if the benefits of providing that information exceed the cost of doing so.
Relevance, faithful representation, cost-benefit again.
Yeah.
Now, here's another point I think is a massive aha moment for many people, especially accountants trained under older rules. The framework does not include a probability criterion for recognition.
That's right. This is a huge shift.
My understanding, and I bet for many listeners too, was always that something had to be probable, more likely than not to be recognized, especially liabilities or assets. This changes things significantly.
It really does. It's a seismic shift from older thinking that often relied on these sometimes arbitrary probability thresholds, like 50% or more likely than not.
So what does it mean in practice?
It means an asset or a liability can exist conceptually, even if the probability of an inflow or outflow of economic benefits is actually quite low.
Wow. So you could have an asset with only a 10% chance of paying off?
Potentially, yes. The definition might be met. But, and this is the crucial part, the key factor for recognition isn't probability anymore, it's relevance.
Back to relevance.
Exactly. If the probability of that inflow or outflow is extremely low, then formally recognizing it on the balance sheet might not actually be the most relevant information for you. It might even be misleading.
So what do you do instead?
Instead, perhaps a detailed disclosure in the notes talking about the potential size, the timing, the factors affecting that low probability might be far more useful to you than putting a potentially misleading number on the main statements.
So it shifts the focus from a strict probability hurdle to providing the most useful information, which might be disclosure rather than recognition if the probability is low.
Precisely. It's about transparency and usefulness for the user's decision-making, not just ticking a probability box.
That's a really important shift in thinking. And derecognition then, taking things off the books.
That aims to faithfully represent two things. First, the assets and liabilities the company still retains after whatever transaction happened. And second, the change in the company's assets and liabilities that resulted from that transaction.
So it cleans up the picture accurately after something's gone?
Essentially, yes.
Yep.
It ensures that when an item is removed, the statements clearly show the impact, what's left, and what changed because of the removal.
Right. Okay, moving on to Chapter 6, measurement. This feels like one of the thorniest areas in accounting. An asset can be worth different things depending on how you measure it, right? How does the framework guide this tricky decision?
It's definitely a pivotal and often complex area. Selecting the right measurement basis is, as the framework says, a constant balancing act. You're always weighing relevance against faithful representation.
What else do you consider?
You have to look at the specific characteristics of the item itself. What is it? How does it contribute to the company's future cash flows? And again, always the cost constraints. Some measurements are much more expensive to obtain than others.
And generally, specific info is better than generic.
Generally, yes. Entity-specific information tends to be more useful than just standardized descriptions when communicating value.
Okay, so let's start with the classic historical cost. That seems the most straightforward, right? What you paid for it.
It's often the starting point, yeah. And for non-financial items like buildings or equipment, historical cost gets adjusted over time for usage. That's your depreciation or amortization.
Right.
Or it gets adjusted downwards if its value isn't recoverable anymore. That's impairment.
Okay.
For financial items, like loans, historical cost is usually adjusted for things like interest earned or paid and repayments. That's often called amortized cost.
But historical cost isn't always the best, right? When might it not be relevant?
Correct. It might not provide very relevant information, especially for assets held for a very long time where prices have changed dramatically. Or think about financial derivatives. Their historical cost might be zero or very low, but their current value is what really matters. For those, a current value is often much more predictive of future cash flows.
Okay, so that brings us to the current value measurements. You mentioned there are 3 key types.
That's right. 3 main current value approaches. First, you have fair value. This is defined as an exit value.
Exit value.
Yeah, it's the price you'd receive if you sold the asset or the price you'd pay to transfer a liability in an orderly transaction between market participants right now at the measurement date. It's market-based.
What the market thinks it's worth today. Got it. What's next?
Second is value in use for assets, or its equivalent for liabilities, which is called fulfillment value. This is usually seen as an entity-specific value, though often still an exit concept.
How is it calculated?
It's based on the present value. So discounted back to today of the cash flows the company expects to generate from continuing to use the asset and then eventually selling it, or the cash flows needed to settle the liability. It's about what that specific item is worth to this particular company, given how they use it or plan to settle it.
Okay, entity specific. And the third one?
The third is current cost. This one is distinct because it's usually an entry value.
Entry value, so replacement cost.
Pretty much. It's what the entity would have to pay today to acquire an equivalent asset, or what it would incur to take on an equivalent liability at current market prices. What it would cost to get it now.
Fair value, market exit, value in use, entity-specific exitus, current cost, entry replacement. Okay, so given these options, when might a current value actually not be the most relevant choice? Or maybe less relevant than good old historical cost? It feels like current value should always be better.
That's a really good question because intuitively, current sounds better. But it's not always clear-cut. The framework points out that fair value, for instance, might not be the most relevant measure if an item is being held solely for use within the business, like highly specialized factory machinery that isn't really traded. Or if it's held primarily just to collect contractual cash flows, like a simple loan portfolio where you just expect to get the principal and interest back.
Right, you're not planning to sell it.
Exactly. And particularly for assets that are used together in combination to generate cash flows. Think of all the different machines in a factory working together to produce goods. A cost-based measure is often considered more relevant.
Why is that?
Because in that situation, the key information for you as a user is often about comparing the cost of production, based on the cost of those machines, to the eventual sales margin of the goods produced. The individual selling price of each separate machine might be less important than its contribution to the overall production cost.
That makes sense. The context of how the asset is used is critical for choosing the measurement. Okay, last chapter. Chapter 7, Presentation and Disclosure. This is about how it all gets laid out for us to see. What are the main principles here?
This chapter sets out the principles for how items should be presented and disclosed in the financial statements themselves. How is it all organized? The general rule is that income and expenses go into the statement of profit or loss. That's the default.
The PA.
Right. However, exceptions can be made. Sometimes, relevance or faithful representation is actually enhanced if you include a change in the current value of an asset or liability somewhere else.
Where else would it go?
Into other comprehensive income, or OCI.
Ah, OCI. This is where things can get, well, genuinely interesting, maybe even controversial for people trying to analyze performance, right? Because the whole idea of reclassifying items out of OCI and into the profit or loss later on, that's a hot topic.
Is indeed. Very contentious in the accounting world.
Why is there such a debate? I mean, some people argue everything in OCI should eventually hit the P&L, others say it should never happen, and some say only certain things should. What's the disagreement about?
It really boils down to fundamental views on what the profit or loss statement should represent and what you as a user want to see as performance.
Okay.
On one side, you have the argument that all gains and losses, no matter what they are, should eventually flow through the main profit or loss statement. That gives you a single comprehensive measure of total performance over time.
The clean surplus idea, sort of.
Kind of, yes. On the other side, people argue that certain items often parked in OCI, like, say, gains from revaluing property, or some foreign currency translation differences are volatile or maybe unrealized and shouldn't be allowed to distort the core operating performance shown in the main income statement. They argue it makes the P&L noisy.
So what's the framework's verdict on this? Does it take a side?
The framework tries to find a balance, guided by its core principles. Its position is that reclassification from OCI to profit or loss is appropriate only if doing so actually makes the information in the profit or loss statement more relevant or provides a more faithful representation for that period.
So only if it helps the user understand that period's performance better.
Exactly. And crucially, if there's no clear basis to identify which future period the reclassification would relate to or when it would enhance relevance, then reclassification is not appropriate. It shouldn't just happen automatically.
It always comes back to relevance and faithful representation for the user.
Consistently. Those are the touchstones.
Wow. Okay. What a journey through this framework. We've really peeled back the layers today. We've seen just how crucial it is as the foundation for IFRS globally. We've dug into the vital roles of relevance and faithful representation. We touched on fascinating nuances like prudence and even those tricky asymmetric applications.
Yeah, like in IAS 37.
And we explored the careful thinking behind choosing different measurement bases, historical cost versus the current value.
And hopefully, understanding these underlying principles really equips you, the listener, to, well, more critically analyze financial information when you see it.
Yeah, to appreciate the thought process behind it all.
Right. Appreciate the judgments involved, the principles applied, and ultimately make more informed decisions yourself. Whether you're investing or analyzing a competitor, or even just curious about how this financial data gets put together.
Absolutely. It's not just black and white numbers. So maybe a final thought to leave everyone with. Given everything we've discussed, the inherent uncertainties in business, the careful balancing act the framework performs between relevance and faithful representation between different characteristics, how does this deeper understanding maybe challenge your assumptions about how exact financial figures really are?
That's a great question.
And what does that realization mean for how you approach any reported financial information from now on, knowing the sheer depth of judgment and principle that sits behind every single number you see?